Hello everyone, and welcome back to Dr. Talk's Quant Lab. Over the last few lectures, we mastered the raw data of the market, volume, cost, and order flow. But the raw data is incredibly noisy. If you stare at naked price candlesticks all day, the violent intraday swings will trigger your emotions, and you will make poor trading decisions. To trade like a quantitative professional, we must mathematically smooth out that noise to reveal the true macro direction of the market. Today, we are firing up the trend engine, starting with moving averages. Mathematically, a moving average is the average closing price of an asset over a specific window of time. Let's look at the standard moving average, or MA. It trades every single day exactly the same. If we look at NVIDIA in mid-April and average the close from the 10th to the 16th, the math gives us an MA5 of exactly $194.33. But the standard MA is slow. It suffers from mathematical lag. To fix this, we use the exponential moving average, or EMA. The EMA algorithm applies a high-V multiplier to the most recent price action. If we run the recursive formula on those exact same dates for NVIDIA, because the price spiked violently on April 14th and 15th, the EMA reacts instantly. It pushes up to $195.38, tracking much closer to the current price than the lagging standard MA. Now, I need to address a question you will all have the second when you open your trading apps. If you calculate the 5-day EMA by hand, you get 195.38. But if you look at your trading app, it may say 194.26. Did the app do the math wrong? No. This is what we call the EMA Memory Effect. A standard 5-day moving average completely forgets day 6. It has a strict cutoff. But because the EMA is a recursive formula, where today's number is built on yesterday's number, it has infinite memory. Your app didn't start calculating 5 days ago. It started years ago at the beginning of the data feed. That historical anchor puts the app's number slightly lower. Does this break our strategy? Not at all. We don't trade based on penny values. We trade based on the slope and the hierarchy of the lines. What does that line actually represent psychologically? It is the average holding cost of the market. If the current price, for example, MA5, is above the 5-day line, okay, is above MA5, the average recent buyer is in profit. They are comfortable waiting, which reduces selling pressure. But if the price drops below that line, recent buyers are trapped at a loss. The second the stock bounces back, they will eagerly sell just to break even, creating a massive ceiling of resistance. This is why we track specific look-back periods. The 5 and 10 track short-term momentum, and the 20 and the 20 and 60 represents the medium-term macro trend, and the 20-day moving average is universally known by institutions as the ultimate bull-bear dividing line. Okay, now let's get back to this app. So first off, how to find this MA or EMA? You just need to look at these indicators and just search for MA. Then you can find MA right here, the simple moving average, MA. Then you click it. And for EMA, you just search for EMA or MA. You can find this EMA, exponential moving average. Then you click. So you will have MA and EMA respectively. And again, you can basically pick either of them. Okay? And then how to set the lines we want. Usually we will have MA 5, 10, 20, 30, 60, 120, and the 200 for MA or EMA. And then you just need to click this 5 for 5 days for MA, and then 10, you just click it, the line will appear or disappear. So we always just look at several lines. If you want, you can make all of them available. For EMA, same thing. Okay, so you can just do make this 5, 10, 20, maybe 30, 60, 120, and 200 available. Okay, so so we can use either of them. Let's focus on the MA. And this is the NVIDIA's daily candlestick. So let's look at here. All right. So let's look at the terminal here to see how these lines interact. How do we know if a stock is in the true macroeconomic trend? We look at the hierarchy. So let's look at this chart of NVIDIA right here. So here is this is a bullish alignment, frequently called a multi-height arrangement. And notice that how the fast 5-day, the orange one, moving average is strictly above the 10-day, okay, the blue line, which is above the 20-day. Okay, this purple curve, and so on. Okay, so above, 60 and so on. So for this one, this kind of, hierarchy, we call it again bullish alignment. They are fanning out and sloping upward. The faster lines act as dynamic support, catching the price before it can fall. On the other hand, let's look at another stock, Intuit. So for the recent price, this is a bearish alignment. The exact opposite is happening. The fast averages are pinned below the slow averages, sloping downward. Every time the price tries to rally, it slams into the declining short-term lines and is violently rejected. Okay? You never buy a stock in this condition. And again, this bearish alignment, the MA5 is below MA10 and below MA20 and etc. It's a very bad trend. Okay, so let's get back to the lecture. We have talked about this bullish alignment, bearish alignment. And finally, I have to warn you about how retail traders lose all their money using moving averages. First, moving averages are not execution triggers. Look at this first chart. If you blindly bought NVIDIA every time it crossed above the 5-day moving average and sold when it crossed below, you would have bought at the top on December 29th, 2025, and sold for a loss on 30th, bought again on the 2nd, and sold for another loss on the 6th. The line is too fast, it causes massive Whipsaw Trap. So do not use these MAs to be your buying or selling points. And second is what we call this golden or death cross. A golden cross is when a fast line crosses above a slow line. Retail traders love to buy when the 5-day crosses the 10-day. Let's look at this second chart. So if you buy here, when this 5-day orange curve across this 10 days, and then you sell it when this death cross happened, then you lost money. Okay, you buy high and sell low. Because both lines are so short, normal volatility causes them to tangle and cross back and forth repeatedly. It is a trap. If you want to use a golden cross, you need the 5-day to cross a much stronger structure line, like the 20-day or 60-day, to confirm a high probability macro shift, and never ever take a buy signal if the stock is trapped completely underneath a declining 20-day moving average. The overhead supply will crash it. Okay, moving averages give us our structural baseline on the main price chart. But what happens if we extract those moving averages and measure the distance between them mathematically? In our next lecture, we are going to build the ultimate momentum oscillator, the MACD. See you in the quant lab.